Good day, AVZ traders. I trust you are well. Welcome to broadcast number 101. Now, sometimes the market starts to move in a direction, trend, bulls or bears, and you're looking at it and saying, well, I didn't get a distinct strategy number one or strategy number one at the open. In other words, I didn't get a distinct breakout that has given me a signal or prepared me for the market moving, but the market is beginning to move. What do I do? Do I sit back and let it go, or how do I find ways to get into the market? When you find yourself in that situation, the first thing to bear in mind is we look for strategy number two when the market is going up or going down. That's what you just got to bear in mind and then look for the opportunities. This is UK 100, 21st April, first candle, perfect doji in the middle of a trading range. And you're sitting there saying, well, what's going to happen? And hours later, you see bears, forming candles, but you don't know after all of this if the bulls are going to come back. But then this happens. You have bears breaking out beneath the low of the first candle, and then tail and follow through. Now, am I in the mode of the market is going down? If so, what do I do? Well, if you're going to jump into the market with that, the thing that you always need to check is a signal that you're looking at. Does it have one times risk reward to the next key level? Yes, it does. So if you want to jump in based on the market is going down, you can jump in there and decide where to put your stop. Measured move stop, of course, is what we would use, and you jump into the market right there. Okay, so and then you manage your trade as we know how to manage our trades. And you get rewarded, and then this happens. And you kind of saying, well, okay, I didn't take that, or if I took it, then I'm still in the trade. If I now see this bear breakout in that doji, we know a doji is a pullback. Market is going down. I've got low of yesterday here. Do I get it or I don't? Because the market is going down. Signal itself is one times risk reward to the key level low of yesterday, which is also the measured move of the first candle. So if you want to get in, you just decide where to put your stop, measured move stop, and still can get in there. The reason you look at one times risk reward is that it allows you time to manage your trade. That's what we're looking for. So two opportunities based on the market is going down, based on the signal having one times risk reward to key levels. If you let that go and say, I don't know, then you're going to have to just wait, because now you come into the low of yesterday and you get the bears breaking out and saying, oh, okay, this is good for the bears. Now I've got to find, strategy number one. First breakout becomes large breakout. There's already a problem with the tails here, so I would wait for strategy number two. I get that as a test of average prices. Now I get an outside candle. Remember, the highest risk reward for strategy number two, we don't want it breaking beneath the low of the trend. And I've always insisted that for you. And the reason is that we're trying to protect our risk reward. Now, the next key level is here, measured move of the breakout of the range, yesterday's range. So you see that and say, but hang on, these bears are very strong. What if that is the first leg from the breakout here to the end of the pullback? What if there's still a lot more for them to go for? And I'm seeing that, and I know it's an outside candle, reduces my risk reward. I'm either going to take it or not. If I'm going to take it, just check. I have one times risk reward to this level. So it's an outside candle. What it does is it reduces my risk reward, but I can take that, put a measure move stop, because I'm hoping to see if we get to the one times risk reward. So you could still do that. That's another trade you could take. None of these are easy, but if you follow the thinking and what you're trying to do and be aware of your risk reward, you can decide to take one of them, none of them, or two of them, depending on how you manage it. Eventually, the bears get to the leg one, pullback, leg two. Really made it difficult for us to get in, but if you follow the logic, you'd have been able to jump into the trade. That one, it is a pullback, but you don't have the risk reward. So definitely that's problematic. That's why if it was up here, it was a test up here, not breaking out here, you still have risk reward. So you can consider taking that. But when it breaks below the end of the trend, your risk reward is compromised and you can clearly see where the problem is. So just do not do anything. Then we have a breakout and we are at the leg one, leg two, and there's a little bit more for the rest of the day. Now let's look at a little bit more before we go. We've broken beneath here, we've come to here. Now, you've broken between beneath two key levels. I would not rush in to take additional trades. Big low test by the bulls. Bulls looking to keep going up. Let's still get a test of average prices here. If you wanted to take it, now, you got nothing down here that can get in the way in terms of key levels. The only thing is that low test. And if you want to take it with a measure move stop, you're hoping the market gets down here, eventually get down there. The key thing, traders, when you break beneath risk range of measure move breakout range of yesterday and leg one, leg two, it becomes much trickier to trade. Yes, there were rewards. That test, you could have still been taken, but I would not be jumping in late into a trend. All right, traders, Dr. George, we shall catch up again. Take care and bye-bye.